For this video, I want to cover stocks and bonds from Chapter 3. Actually, this video will just cover stocks. I'll do bonds in a separate video. But if you want to invest in financial instruments or securities, like stocks or bonds, there are a few ways you can do it. The first is through what we call direct ownership, and that's where you open a brokerage account, and then via that brokerage account where you have to pay commissions, you would directly buy securities in the companies. So I could buy shares of Apple or IBM or Ford or Krispy Kreme. There are several thousand companies that are publicly traded in the United States, and publicly traded means that individuals who have this brokerage account can go and purchase shares of those securities if they have enough money. And typically when you do that, you buy securities in what's called a round lot. You don't have to. It's just a common way that it's done, and I don't really know why it started that way, but it did, and you don't have to do it that way. But a round lot is 100 shares, and you could buy 2 round lots, which would be 200 shares, or 5 round lots, or you could buy what they call an odd lot, which is anything from 1 to 100 shares, or actually 1 to 99 shares. So if I decided I wanted to own 18 shares of Apple, that would be an odd lot of 18 shares. They typically discourage that because Apple has millions of stockholders and they have to communicate with those stockholders. Can you imagine if people only bought 1 share of Apple, how many other stockholders they would have in addition to the millions they've already got? It'd just be an administrative nightmare to keep track of who owned the company. But it's not impossible to buy an odd lot. It's just that the standard is you buy 100 shares. And so 100 shares can be kind of expensive. I'm going to go look up how expensive Apple is right now. I have a couple of files open because I was looking at some things. But when you research a stock, you used to need to know their ticker symbol, which is this 4-character, or actually for Apple it's 4 characters. It can be more than 4 characters. But nowadays you can just search by the company name. But you would input their ticker symbol. So normally I would just type AAPL for Apple, but now I'm going to click on it. This is the current price for Apple, $113. I'm going to round it a little bit. So if I were to buy 100 shares of Apple at $113 each, that's going to be kind of expensive. It's going to cost $11,300 to buy 100 shares of Apple. And so, since a lot of new investors especially don't have that much money that they're willing to put into one company, buying securities directly might not make a lot of sense. So you can also buy securities indirectly. So what we'll call that as indirect ownership through a mutual fund. So you'll buy shares of a mutual fund, which in turn will buy shares of individual companies. If you buy shares directly, you are a partial owner of the stock you've bought or the company you've bought shares of. So I do own some shares of Apple, so I have a very, very small ownership of Apple. But I also have shares in mutual funds which own shares of Apple. But in that case, it's the mutual fund that's the direct owner of the shares of Apple, and only indirectly do I benefit from when Apple does well. Mutual funds are the topic of Chapter 4, so I will discuss them in great deal at that point. And mutual funds can own either stocks or bonds. I can own stocks or bonds directly as well. So I didn't mean to suggest that mutual funds only own stocks because they don't. So let's talk about what is a stock. And I I'm a big fan of Kickstarter. I I'm gonna assume y'all know what that company is. And one of the largest funded projects that Kickstarter has ever offered is that of the coolest cooler. And this cooler has all sorts of things. It has, um, let's see, I'll get to that part in a minute. It has a blender so you can make your mixed drinks. It has speakers that I think are detachable and you can put out on your lawn or the beach for your party. And you can control it with the Bluetooth in your phone, a USB charger, an LED light, a gear tie down, big tires so it won't bog down on the beach, built-in utensils, a split lid and a divider. And this particular campaign raised about $13 million. But when you donated money, or you actually don't necessarily donate money, but when you participated in the Coolest campaign, there were different levels. If you pledged just $5, you didn't really get anything, and you can see that 1,078 people did pledge $5 or more, and all they got was the person wrote their name on his own personal cooler, and he would keep them informed with updates. If you pledged $25, you got a party cup with coolest written on the side and a blended drink guide. If you pledged $55 or more, you got all the things in the other two pledge levels below it, plus a t-shirt reminding you of your outdoor party obligation. You'd only get a cooler if you pledged at least $165. And what you didn't get by pledging $165 or more was actual ownership in the company. You just got the product itself. Eventually, though, and even though they raised $13 million, that's not enough for them to put a cooler in, let's say, every Walmart in the United States or across the world. And they might want to um, distribute that product that way at some point in the future. So they're going to need to raise some more money to be able to do that. What they're doing here by raising this $13 million is raising enough money to produce uh, enough coolers to satisfy all these backers. And they'll have some money left over, but it won't be probably enough to, well, I said probably in the wrong place. They'll probably have some money left over, but it won't be enough to produce an inventory of coolers and then distribute them to Walmarts or Costco's or what have you and try to sell them that way. So they're going to need to raise some more money. I want to talk about how companies raise money, and then I'll define exactly what is a stock. But a company has assets. Those assets could be things like property. For instance, it could be a warehouse for storage, a production facility. I don't know that all this is going to fit nicely in my little box. Things like that. They're going to need equipment, which could be part of their production facility. They're going to need equipment to manufacture those coolers. They're going to need some inventory. They'll have raw material inventory, work in progress inventory, and finished good inventory that's actually ready to bring to stores to sell. They may have patents on their product, and that would be considered an asset. So they're going to have assets like that, and all that costs money. And the more coolers they want to produce, the larger the production facility, the larger the warehouse, the more equipment they're going to need, the more inventory, raw materials they're going to have to purchase to make more coolers. So all that costs money. How do you finance that? You can borrow it. So you can have debt. Debt could be in the form of a bank loan. But as a company gets larger, it's going to be harder to find a bank willing to lend than $10 million. dollars. If a bank is fairly small, a $10 million loan is a big commitment for a small bank. It's risky for a bank, and they're not as willing to lend that much money to an individual business. They could take out personal loans, and that's probably what uh, the coolest not backers, but founders did for a while. But eventually, they're going to max out their personal loans. They could borrow money from family or friends. I've even heard that people start businesses by charging the sums on their own credit cards, but there are limits to how much you can take out that way. You can also sell bonds. Bonds I'll talk about later. Or you can generate equity. But first, let me say debt is all a loan. It must be repaid. There's going to be interest associated with that. If this debt is not repaid, the creditors can force the company to file for bankruptcy. That makes debt risky. Equity can come from selling stock in the company. So selling partial ownership like Apple has done. The coolest cooler has not yet incorporated and sold stock to the public as of this time. That doesn't mean it won't. It might. But by selling shares in the company, going public, it's called, they can raise money that way. I'll show you an example of a company that did that recently in a minute. And then also, you can generate equity internally through what they call retained earnings. Basically by making a profit and not distributing that profit entirely to your stockholders. So let me go through an example of that. Basically when a company sells a product, so let's say Apple sells its iPods, its iPads, its phones, etc. And it makes, I'm using very wrong numbers here, but I'm just using numbers that are easy for me to do the math and fairly quick to type. Let's say they generate $10 million in sales. That's not all profit. They have a lot of expenses. So they'll have what they call operating expenses. It costs money for Apple to make those iPods and those phones, etc. Let's say those expenses are $8 million. That leaves them with an operating profit of $2 million. Trying to get this to all line up and look neat, but that might not always happen. Now, if Apple had any debt, if they had any bank loans, for instance, or bonds, and they owed interest on that, they'll have interest expense. They're allowed to deduct that. That's not considered a basic operating expense. An operating expense would be like the cost of the raw materials that they need to make all their products, the electricity they pay for producing their products, the salaries they pay their workers, all that sort of stuff. Interest expense on any borrowed money is just considered a separate line item. It's not an operating expense. So let's say they've got, I'll have $500,000 in interest expense. So this gives us what they call EBIT, EBT, earnings before taxes. And that would be 1.5 million. And then finally, we deduct taxes. And I'd have to look up the corporate tax rate for a firm that made this much money, but let's just say they're going to pay a third of that in taxes. So that would be 500,000 and their net income would be $1,000,000. Now, what can Apple do with this net income? There are two things that they can do with the net income. They can retain it. I'll call it retain the income. Why do companies retain money? If they're growing a lot and they're trying to expand their product line or expand to different portions of the country or expand internationally, they're trying to boost their growth. They're going to manufacture a lot more inventory to try to sell. They need money to finance the purchases of the raw materials, to expand their ability to produce on the product line or production line. That's why they retain income, to finance growth. That way they don't have to borrow the money and they don't have to pay interest expense on it. So if you've got a young company that's fairly new or a company that's growing really rapidly, you might see them retain all of their income. Or they might pay some of it as dividends. So they'll basically take a portion of this $1,000,000 and they'll pay it out as dividends to all their stockholders. So if they decide to pay a 10-cent dividend per share, if I own 100 shares, I get 10 cents times 100 shares as my dividend. And they typically pay dividends, if they pay them at all, they typically pay them quarterly. So I can pop over to Apple and I'm going to go to this max chart. Down here these are, because I did such a long time period, it's kind of squishing these together, but these are little diamonds with a D in them. That means they paid a dividend. And so as I hover my cursor over one of them, I can see when the dividend was paid. I don't know if y'all can see that right above, it's right here when I stop moving my cursor. So on June the 1st, 1992, they paid a dividend of 0.00429 cents a share. So you can see from like 1987 to 1995, they paid dividends regularly, but then they stopped. And then they didn't start paying dividends again until 2012. And now they pay a dividend of about 52 cents a share. And that's on a quarterly basis. This S stands for stock split. And I think I'll go ahead and talk about that. It wasn't in my notes to talk about, but since I see it on here, I'll explain it to you. So what is a stock split? About maybe 2 years ago, Apple was trading for $700 a share. That's expensive. To buy a round lot would cost $70,000, and most ordinary people don't have $70,000 to put into an individual stock. Again, you can buy a single share of Apple, but most people don't buy it that way. So to become less expensive, what per share, what some companies do is engage in a stock split. And a couple of years ago, Apple did a 7-for-1 stock split, which basically means, let's say I owned 100 shares before, and they were each worth $700. So my total wealth invested in Apple was $70,000. Well, what the stock split will do is give you 7 shares for every one that you had before. So after the stock split, I've got 700 shares, but the price doesn't stay at $700. The price will drop by drop to this amount divided by 7 divided by 1. So 7 divided by 1 is 7, and divide 700 by 7, it'll drop to about $100 a share. And has my total wealth changed? No, I still own well, I own 7 times as many, but they are valued at 7 times less. But I still have a net worth position of 70,000. So my position hasn't changed as an owner, but new people who want to come in and buy a round lot, it will if they buy a round lot, it's going to cost them $100 a share times 100 shares. It'll only cost them $10,000. And I do know that 10,000 is still quite a bit for an individual investor, but it's a lot better than 70,000. So that's a stock split. They used to be fairly common. They are not nearly as common now as they were, let's say, in the 90s. But you'll still see stock split every so often. Now, to raise money or to issue stock, companies do what's called an individual public offering. So I'll go say they undergo an initial public offering. This is known as an IPO, and they typically hire an investment banking firm to help them with this process. So as an example, y'all may have heard of Goldman Sachs. They're a very well-known investment banking company. And the investment banking company will set the IPO price, the initial public offering stock price, and that's how much each share of stock will sell for. Apple knows if it were to issue any additional stock right now, it would sell for its current price, which is about $113, because Apple's price is already traded on the stock exchange. But if Coolest were to go public, their stock has never been traded before on the stock exchange, so we really have no idea how investors are going to react and how much investors are willing to pay for a share of Coolest stock for part ownership. So the investment banking company helps to figure that out. And I thought I had a site with recent IPOs somewhere. Here we go. So I just Googled recent IPOs and I found this list, and I was going through trying to find a company that I recognized. A lot of IPOs, I mean, they're companies that haven't been publicly traded before, so they're not necessarily in the news a great deal. And so I don't recognize most of the names, but this one I did recognize. And it's Planet Fitness, maybe you've heard of it. Their IPO price was $16 a share, and that was established by the investment banking company in conjunction with Planet Fitness. They hoped to sell 13.5 million shares of stock at $16 a share. The goal was to raise $216 million in cash that they could use to expand. And then everybody who buys the IPO pays $16 a share. It's not resellable, though, until it starts to trade on the stock exchange. Now, Planet Fitness is trading on the stock exchange, and at that point, its price starts to vary. So, well, I don't really want y'all to see my emails, but they popped up anyway. Um, so now, Planet Fitness's price is varying, and over here it's just tracking the price today. If I go to the past 5 days, it's only been publicly traded for a short while, but now you can see how it's varied over the last few days. And it started out here at 16.28. It reached a peak up here. Actually, its peak is up here at 18. So, a price rise of $2 on a $16 price over a couple of days isn't that bad. But there have been times when IPOs have dropped in price right after they've started being publicly traded on the stock exchange. This one just was not an example of that. So the investment banker will help set that IPO price, sell shares to investors in what's called the primary market. The primary market is where it's not being traded on the stock exchange yet. The investment banking company is trying to find people with ideally lots of money who want to buy lots of shares, and they'll pay the IPO price for them. And then eventually, fairly soon after, shares will trade in the secondary market. I'll fix my typos later. So on the stock exchange, well, some of my typos. And the price will vary. The price can vary from trade to trade. And there could be, hundreds, if not thousands, of trades for that particular company in a day. So now a stockholder is a partial owner of the company. They typically don't have any say in how the business is run. Like I do own some shares of Apple, but Apple never calls me and asks me for suggestions about what they should be doing to run their business. Stockholders do get to vote on very major issues like who is on the board of directors. And if the company got a takeover bid from another company, then we would get to vote on that. So only major issues like that do stockholders get to vote on. And how do stockholders earn a return? The first way is through dividends, but not every company pays dividends. Apple pays a dividend. I'm going to pop back over to Apple. Again, they paid a dividend of 52 cents about a month ago. That's not a lot of return on a stock that you'd have to pay $113 today to purchase. And again, not every company pays a dividend. Only about 30% of companies pay a dividend. So there's a hefty portion that don't pay dividends. The other way to earn a return is through a capital gain or a loss, because returns can be negative, in the stock price. So you generate a capital gain if you sold it for less than you paid for it. A loss if the opposite happened. If you sold it for, I don't know what I said. Capital gain if you sold it for more than what you paid. Capital loss if you sold it for less than what you paid. So I'll do an example. I have a friend who's really fond of GE. So I'm going to do GE because I crunched the numbers for GE before I started the video, so I have the numbers in front of me. GE right now is selling for $24.82. And you can see it does pay a regular dividend. It's not exactly quarterly, but it's certainly regular. And it's not a huge amount, 15 cents a share here, 23 cents a share there. But its stock price is a lot cheaper than Apple's if we're comparing GE's dividend to Apple's. If you'd bought it exactly 5 years ago, or almost exactly, September the 6th you would have paid. Right here is the price, and it moves as I move my cursor along different dates. So here I am at September the 6th. It would have cost $15.98. And if I sold it today, it would have sold for $24.82. So now, and then I also, oops, um, where did my Apple go? Or GE. I summed all of these dividends. You can download this information to a spreadsheet and easily sum it. So I did that, and the dividends were $3.77 in total over those 5 years. So now let's calculate our return for GE. This is called a holding period return. I'm not going to calculate the annual return. I'll do that later. But GE's holding period return for the past 5 years. What I would do is take the selling price plus any dividends that I received, subtract the purchase price, and then divide by the purchase price. So let's just fill in that data for GE. The selling prices, if I'd sold it today, I could sell it for $24.82. The dividends totaled $3.76.5. The purchase price was that $15.98. And then all that divided by the purchase price of the $15.98. That gives me a holding period return of 78.88%. And that sounds like a huge return, but remember, it's not an annual return. It took 5 years for me to be able to earn that much, which is not the same. You might think, can't you just take that 78% and divide by 5 to get an annual return? It doesn't work that way. To find the annual return, I'd actually have to use the interest factor tables. And because this one pays dividends and they're not an annuity, it's not going to be easy to use the interest factor tables. I'll show you in another example with the interest factor tables later. You can break this holding period return into what they call the dividend yield. I could just look at the 3.765 divided by the 15.98. I'm going to just crunch that really quickly. So that's 23.6%, or actually 5.6%. And then the price differential was a benefit. We were able to sell it for quite a bit more than we paid for it. So they call that the capital gain. It would have been a capital loss had we sold it for less than we paid. The capital gain would be the 24.82 minus the 15.98 divided by the 15.98. So the price gain is 884, and divide that by the 15.98 gives me 55.32%. If I sum these two percentages, I should get hopefully 78.88. There might be a slight rounding error there. And so most return from stocks is in the form of capital gains. Stocks over the long run generate capital gains, not losses, but there are certainly stocks that lose money at different points in their lives. And just for fun, I think I'll go look at some of those. One of my favorite, and I don't mean to laugh, it was horrible. One of my favorites is Crocs. Crocs, you're probably familiar with their product. They make those gardening shoes that became really popular. I don't know if they're still popular. But here's a chart that tracks Crocs' price, stock price, since they first started publicly trading in 2006. But at one point, their stock was trading for $74.75. This was in 2007, right at the time of the financial crisis. Their stock in the period of about a year went from $74.75 all the way down to about $1.20 at its low point in just a little over a year. That's an, that's just an amazing loss, shocking loss. So if you'd bought it here at its peak and sold it here, you would have lost tons of money. But if you'd bought it here at its low point and perhaps sold it here at for 31.33, you'd be quite happy. Another example, I'll do BP. I don't really want to go the max on that, but I guess I will. This is when the Deepwater Horizon, I think it was here. Oh, I don't know. Yeah, I think it was here. This was when the Deepwater Horizon oil rig exploded in the Gulf of Mexico, and then it took them a few months to recover, or maybe it was here. I probably should have looked it up before I looked up BP. I actually think it was here because I know it took them a couple of months for them to cap that oil well and stop the spillage in the Gulf. But you can see BP's has some huge price fluctuations. Not as huge as Croc's, but still it's had quite a few fairly serious drops in the last few years. BP is a fairly volatile stock. Um, let's look at GE again, and I'm going to go to Max. GE was pretty flat for quite a long time. It had zoomed up in 2001, but then it dropped substantially, and you can see it's had a couple of big drops as well. So what I'm trying to get at is stocks prices can be really volatile. If you buy them at the right time, say here, and you ride their upswing and sell them then, you'll be happy. But if you buy them while they're at their peak and then sell them when they're down here at the trough, you're going to be very unhappy. And individual stocks tend to have high peaks and deep troughs or deep valleys. Their prices are quite volatile. So that leads to a lot of risk from an investor's viewpoint. Risk that we might sell it at the wrong time. We might get scared. We might see stock prices plummeting and decide to just get out of the stock market because it's too risky for us. That causes a lot of low returns, negative returns. And it turns out we'd probably be a lot better not letting our emotions crowd our judgment. I'll talk about that later. Okay, I have actually more to say about stocks, but I will do that in a different video and a video on bonds as well.